Welcome to Hedge Fund Tips with Tom Hayes, episode number 38 for the VideoCast and 28 for the podcast for the week ending July 10th, 2020. Hope everyone had a great week. A lot of nice developments toward the end of the week. But as we do each week, I'm going to start off with the media. First off, on Fox Business on Monday on the Clayman Countdown, want to thank Ellie Terrett, Cheryl Cassoni, who was filling in for Liz Clayman, and of course Liz Clayman for having me on. And this was a great segment. If you haven't had a chance to take a look, watch it, because what we're discussing here, and the market was up on that day, was why the market was up. And what's really happening with the analysts is they're starting now to see, I talked about something called the Citi Economic Surprise Index, which on that date had hit an all-time record of 185. Now it's well over 200, and that simply measures the percentage of economic data that is exceeding expectations, and it has been off the charts for the last couple of months. So it's nice to see that rebound. And then we start to talk about the cases around the country in areas like the epicenter versus some of the hot spots in the Sun Belt and the implications. So definitely worth a listen. Thanks again to Ellie Terrett, to Cheryl Cassoni, and Liz Clayman. Moving on to the article of the week. We called it the AC/DC Back in Black Stock Market and Sentiment Results. That is a classic rock band, and I thought it was appropriate because it's interesting to see the divergence in the different indices year to date. So of the major indices, so far the NASDAQ, the tech weighted, is the first one to make it out of the red and back into the black, hence the song. So we listed the December 31st, 2019 closing prices. The S&P 500 was at 3230. The Dow was at 28,538, NASDAQ at 8972, and the Russell at 1668. As of this article, which was written Wednesday night, posted Thursday morning before the open, before the continuing claims, etc., the S&P needed about 1.91% to get to positive on the year, which is pretty amazing considering all we've been through. The Dow needed 9.47% industrial weighted, and the NASDAQ was already up over 16.9% year to date, and the Russell needed 17.24%. And that looks a lot more like the Main Street smaller businesses that are lagging, and we see it in our everyday lives. So I started out with this chart, and it really pointed out, which we've talked about, the market rallied basically 35% off the bottom in the first 35, 36 days, and then it effectively did nothing for 60 days. It had this consolidation box, then popped up and retested it, breakout back test, and was effectively nowhere about a little less than about 3 weeks ago. And then retested again towards early July, and just then. So now we're coming up closer to the top of the box where we can break out for a positive year to date. We failed at that level in the beginning of June. There's also a gap for people who are technicians. I don't pay a tremendous amount of attention, but I do keep it on the radar. There's a gap that goes up to about, looks like about 33.25 that has to be filled from early March at some point. And then all-time highs would be above 33.93 moving forward. So it'll be interesting to see whether we're able to push through and get positive on the S&P 500 in coming weeks, or if it's got to work this box for a little while and consolidate more, and it'll be months off until we get positive outcomes. And we're going to talk about a number of the factors that will make that determination moving forward. So the lyrics to the song, which I liked, was, it said, "Forget the hearse, because I never die. I've got 9 lives, cat's eyes, abusing every one of them and running wild. It's not dissimilar to the action of the S&P. Basically, you can throw everything at it in 2020, an impeachment in the House, a plague, as we call it, the invisible enemy, all these different things just being thrown left and right, different unrest, and yet it continues to plow higher with the help of massive, unprecedented domestic and global stimulus, liquidity, and aid, direct aid. So that was a great starter song. And this was the economic surprise index that I covered on the Clayman Countdown. And you can see here, since Monday, it moved up even higher to a record here after coming off a record low just a couple months ago. So it was, missing expectations to the downside. Now it's beating like crazy to the upside. And we went into a number of the data points that have really just come back to even pre-COVID levels already. First, you want to see the China Services PMI just exploded last week. And that's important because they were 3 months behind us. So, rather a couple months behind us. So they peaked in early February. And we peaked in early April in the epicenter in the United States, New York, New Jersey, Connecticut. So it's nice to see them all the way back up here. They had the highest services PMI since 2010, effectively, coming out of the last crisis. That was staggering to see. The U.S. ISM non-manufacturing, again, we're 2 months behind them, but we delivered 57.1. Anything above 50 is expansion, so we're returning to growth, and the expectation was just barely above 50, 50.2. We came in at 57.1. ISM non-manufacturing business activity off the charts. We haven't seen since for over 2 decades. So that was just huge to see, coming in at 66 relative to a forecast of 49, and last month was 41. U.S. Services Purchasing Managers Index, this was services as opposed to manufacturing. And this one exceeded expectations. Last month was 37.5. This month came in at 47.9. And job openings beat expectations. They were expected to have 4.85 million, and they had 5.39 million. So what's new and what the market started to price in, because if you remember towards early July, just moving back up here, we were really going nowhere. We were back to retesting, levels that we had hit back in April. And what's changed is that analysts are now starting to say, well, if the economic data is so good, that has to impact how CEOs are what they're seeing in their businesses, how they might guide, and potentially that earnings came in slightly better than very, very, very low expectations. As I said on the Clayman Countdown, expectations for Q2 are abysmal. Expectations for guidance were abysmal, and that narrative is starting to change, seeing the economic surprise index. So that is a key indicator that we look at. And we'll know more starting with banks next week on Tuesday, July 14th, JP Morgan and Wells Fargo report. And the next section of the article was, did someone say banks? And you all know I've been talking about banks for a couple weeks now, and we've loved banks since Wells Fargo crashed 50%. We've been interested since the COVID crisis, and it's just been trading in a range since then, and that started to change today. We'll see if we get follow through, but we actually had a situation today where Wells was upgraded to outperform from neutral by Baird, and this is from the fly, by the way, and put a $35 price target. We'll talk about the significance of that in just a few seconds. So what has been going on with Wells, which is a bellwether, is that they pre-announced that they would be cutting the dividend on July 14th, and they would say by how much. The case that we made right after they made that announcement, which, let's see, what's the date of this? So that was June 29th they made the announcement, was that the last time Wells Fargo cut their dividend, they actually made the cut, which will happen on July 14th, was on March 6th, 2009. Now, they cut it 85% at that point, and once the bad news was out, so they sold the rumor and then they bought the bad news. Usually it's buy the rumor on good news, and then when the good news comes out, you sell the rumor. But when it's feared news, you sell the rumor, and then once the bad news is all out and there's no more bad news to fear, then you can buy it because it's at a low. And you basically had a 256% rally after they announced the bad news the last time. Now, there are a lot of similarities, and the one thing that I came up on, and I couldn't figure out where, but it was, I believe it was on Twitter, if you Google search by WFC, but I came across an interview that Warren Buffett did in 2009, right around the time of the dividend cut for Wells Fargo. And basically what he said, and it's still, by the way, one of Berkshire's top and Warren Buffett's top 5 holdings, you could effectively copy and paste his sentiment from the 2009 dividend cut, the crisis period, to today. So the interviewer from Fortune asked him, what if the Treasury imposes new capital requirements? Will it hamper their earnings power? And what Buffett said was, I don't think it'll hamper their earnings, but if you make them sell a lot of common equity, it would kill the common shareholder. It wouldn't increase the earnings power in the future, and it would increase the shares outstanding. Wells, if they want another $10 billion in common equity or something like that in Wells, they'll have it in a very short period of time at this dividend rate. In March, Wells cut its dividend by 85%. This was again in 2009. Wells will be piling up the equity while they're paying nominal dividends. They could afford to pay the old dividend, but since they won't be paying the old dividend, that's $4 billion a year or something that they'll be adding to equity. So I did the math. The consensus is that on Bloomberg was that they would be cutting the dividend down to 20 cents a quarter from 51 cents a quarter, so 80 cents a year down from $2.04 a share. And the math that I calculated was that they would save $5.1 billion. So in 2009, by cutting 85%, they saved $4 billion. Now they'd be cutting the dividend less than that, closer to 60% or so versus 85%, and they'd be saving $5.1 billion. They're not saving, they're retaining that, and that's still, as a shareholder, that's retained equity to your value. That intrinsic value accretes to you, whether they pay it out now or pay it out later. And that's what Buffett was saying actually in 2009, which is interesting because we were talking about that in the last couple of weeks. Now, Buffett goes on to say, I would have been fine if they just said, look, we'll quit paying any common dividend until our equity has gone up by whatever it might be, 10 billion or 15 billion, and they'll get there in no time. Then they could pay the regular dividend. Now, they could do the exact same thing now. They could say no dividends, and they would probably gain, close to $9 billion in equity in the next 12 months, $8.5–9 billion of equity without doing anything different. And he says they elected to do this. They elected to do it this other way because everybody seems to be kind of doing that. And I think the same thing will happen now. There was an article this week. I talked about a cut to 20 cents. The analysts here, Carlton English is the author. This was June 30th, the day after they announced they would be cutting on the 14th. She said that most analysts were looking to about a 50% cut, which would be about, down to 25 cents versus my estimate of down to 20 cents. It doesn't really matter. I mean, it's in the ballpark. If expectations are 20 20 cents consensus on Bloomberg and they only cut to 25, that could be positive. But it really doesn't matter whether they pay it out now or they pay it out later. That is shareholder value irrespective. So, and my sense is they will not cut the dividend 100% to build up equity because they don't really need it. They meet all the capital requirements, even in the most strenuous circumstances, which have not been realized with COVID. But their tier 1 capital ratios are fine. Everything's fine, except they have to, because they've had write-downs because of the past sales practices, etc. They can only pay a max of the last 4 quarters earnings average. And so that's how they'll cut. But basically what Buffett goes on to say is the idea of foregoing all or most of the dividend for a year to build the equity ratio up, if that's what the government wants, that's fine. And Buffett, as a major shareholder, is saying, I don't care. They can pay me now. They can pay me later. They're still going to do the business. And as he says, but that isn't really the key to the future of Wells unless the regulators make it the key to the future of Wells. The key to the future of Wells is continuing to get money at very low cost. And by the way, they're getting money at lower cost today than they were in 2009 at the time of this interview. Then he says, selling all kinds of services to their customer and having spreads like no one else has. They have one of the biggest mortgage businesses in the world. In case you haven't noticed, even in housing markets like Connecticut, which has basically been in a housing depression since 2007, no rise in net home prices, is now in fuego. A friend of mine does that in town, and he was saying everything's selling, the average of 101 sales in the last month sold at 97% of ask, which means a lot of them are selling over ask in bidding wars as millennials accelerate the trend that began before COVID of housing formation and moving out into, Connecticut and other states like that. And now, with COVID, people wanting to get out of the city quickly and have that type of lifestyle. So 85 million boomers, the mortgage demand is going to be there, and Burke and Wells is going to be best positioned to service those needs, whether they pay out a dividend now or pay out a dividend later. As I said on the VideoCast podcast last week, the Fed capped what they could distribute and pay out in dividends in the short term. The Fed did not cap what Wells Fargo can earn. And that's the most important name of the game. Yeah, they'll take credit reserves. Yeah, they have all these negative expectations on Q2 credit reserves, etc. And they'll do that. But the CEO of KBW, Thomas something or other, you can Google it. That's one of the biggest, most specialized investment banks for the banking sector, as well as Mike Mayo, who's an analyst at Wells Fargo, so he can't talk about Wells Fargo. But they both made the exact same point. This is an short-term income statement recession for the banks. This is not a balance sheet recession as you had during the Great Financial Crisis. So they're gonna bounce right back. And historically, anytime that you can buy banks at a huge discount to book, which we're going to talk about right now, this was a chart put out, I think today, also by Carlton English. She's an author at Barron's that you definitely want to follow. She's put out a number of good articles on banks recently. I think she reads my notes too, but I can't say for sure. Nonetheless, maybe I'll send her the podcast this week. So basically, this chart goes through the major banks and their price to tangible book, their price to book, their latest return, the return on equity in their latest filing, and their 3-year average return on equity. So you see these companies that, I've always tended to be a mean reversion player, and that works well in the long term. And when I say long term, the key here is I put out this quote today from Peter Lynch, a legendary mutual fund manager, and he said the key to making money in stocks is not to get scared out of them. And, a neighbor of mine asked me yesterday, they're like, they were driving by. I was getting the mail out of the mailbox. They're like, hey, do you think I should be buying, gold and FANG and all this stuff, which, are at all-time highs? And I said, look, you can do that. That's not what I do. He's like, well, what do you like? I said, I'm buying banks here. And he said, banks? No one wants banks. I was like, yeah, well, that's what I'm doing. And he's like, I'm like, Wells is trading at a 30, I think it was 38%. She has today, I guess it moved up a little bit, 35% discount to book. Just 2 years ago, it was trading at a 75% premium to book in the mid 60s. And he's like, oh, that's interesting. And I said, yeah, but the difference between you and me is that if it goes to 15, I'm going to be buying more and you're going to be selling to me if you buy tomorrow. And he's like, well, what do you mean? You think it could go to 15? I said, actually, I don't think it can go to 15, but if it did, I would be adding more. And I'm actually going to talk about a stock later in this podcast VideoCast that I've had for a while. And it has moved around like that, and now it's up like 50% off the basis. But there's another quote by Peter Lynch, and maybe I'll put it out on Monday. He said something to the effect, in line with the key to making money in stocks is not to get scared out of them. He talks about stocks. I think it was from a speech he did in Boston. You can Google it on YouTube. And or search for it on YouTube. And he says, I've bought many stocks at $12 that went down to $2 and ultimately wound up at $30 to $60. And for most people, they're just buying price action. And there's no, over time, you're going to get smashed doing that. If you don't know what you're buying, if you don't know the durable nature of your business, then when you do get these swings, like Charlie Scharf is the CEO of Wells Fargo. He bought $5 million of stock in March. He pulled out his checkbook, and he gets tons of stock as the CEO, so he didn't need to buy it. He bought a ton of it, $5 million worth, out of his own pocket at about $28 a share in March after, Wells crashed. I guess at that point it was 45, 46. And it went on to, crash even more to like 52, 55. So it got down to $24 from $28. So do you think he cares? Do you think if it went to $20, he would sell the stock that he bought at $28? Or if it went to $15, he would sell the stock that he bought at $28? No, because he knows 2 to 3 years out, it's going to be back at 60, 70, maybe even $80. Maybe it takes 3 years, maybe it takes 4 years, but it makes no difference. And that $5 million he has will be 10 or it'll be $15 million. And that's the core difference. If you know that these stocks trade at a range of, a discount to book, the mean is probably a slight premium to book over time. And in euphoric periods, and when do banks typically outperform is coming out of recessions. We've just had 2 quarters of negative growth. So whenever everyone starts talking about recession this month, then it's behind us, and the economic data is already showing you that we're in recovery, not recession. But people will talk about recession because they're backward looking to the 2 quarters of negative growth. Banks and cyclicals do the best coming out of recessions, and this table talks about the different discounts. So do I want to buy the ones that are already trading at a premium to book, or do I want to buy the ones that are trading at a discount to book with expectation that they'll revert to the long-term mean of a slight premium to book, or a euphoric mean of 1.5 times to 2 times book? And that's the opportunity with Wells. Right now, Wells is trading also at a discount. Their latest filing had a 7.2% return on equity. Their 3-year average was 10. So their tendency is to produce at 10% return on equity. They had a short-term impairment because of all these legal costs, because of all the backward-looking problems before Charlie Scharf was the CEO that they've cleaned up, and they've taken the charges, etc. So when they revert back to that 10.3% mean return on equity, and even higher in previous years, and back up to book like they did after they cut the dividend the last time, and maybe even a premium if we get euphoria getting, if we get anything like the Fed estimates and Goldman Sachs, which I also talked about on Fox Business. Goldman Sachs took down their 2020 GDP to like -4 something, which is actually better than the CBO. It's better than the IMF, which I made fun of 2 weeks ago because they're always the most negative people in the world. They were like -8% for this year. But Goldman Sachs left their 2021 GDP growth to 5.8%, which was above the Fed consensus. You get growth like that, the cyclicals and the banks are going to be flying through the roof, and they're not going to trade at their mean valuation, historic mean. They're going to trade above that because there's going to be a panic euphoria buying in. So that's what we're betting on. And you can see all these different groups. So Goldman's trading at a discount. Some people like that, but they're trading in line with their historic return on equity. So the last 3-year average, they haven't shown that they can exceed that performance. Wells is showing, number one, they should revert back to the mean on book. Their book wasn't even impaired during the great financial crisis, which was a balance sheet recession. So actually, let me pull that up, because when I did the few thoughts on the Wells Fargo dividend cut cap, you can find that article in the site. I showed the book value per share through the years. And if you look, 2007, it was $14. Through the crisis, their book value per share actually improved, even though their earnings and dividend got hit in the short term. So their book value was 22. Now it's about $40 a share. And it just, that intrinsic value continues to compound. And as you can see here, in 2018 or 2018, their book value was $37 a share, but the stock traded up to $66 a share. Right now, their book value is about $40 a share, and it's trading only at $25 a share. So you can just get a sense historically of where it trades, and these are really tremendous opportunities. And you can see these other banks and compare them that Carlton put out. That's in Barron's. And then she also put another article out that Wells Fargo stock has potential because a broken bank can be fixed. And she talks about a couple analysts who say, as bad as it is with the legacy stuff they're cleaning up, and they're Wells Fargo will also slice its 51-cent quarterly dividend by as much as 25 cents. So they're looking at 26 cents. I was looking at 20 cents. I was more negative than these guys are. But the other thing that he says that's really interesting is Wells Fargo could still discuss how it plans to control expenses and provide a long-term return on tangible equity target. Some hard targets, underscoring management's determination to deliver better to its shareholders, could provide support to the stock in the aftermath of another weak quarter and dividend cut, Roth-Katsky wrote, saying that the bank could provide a 3 to 5 year target for hitting a range of 12 to 15% return on tangible equity. It would be one step in getting Wells Fargo back on track. Having watched numerous turnarounds over the last 3 decades, this guy Roth-Katsky has been around forever, we are a firm believer that a broken bank can be fixed. And this is, her name is Susan Roth-Katsky. That's her full name, Susan Roth-Katsky. She's from Credit Suisse, so you can look her up. And she makes a really key point here. But if you got the return on equity, forget about the 10% return on equity when it traded up to 75% premium to book value. Imagine if you got a 12 to 15% return on equity. It could effectively, if we get into a euphoric state coming out of a cyclical recovery, you could get it to trade at 2 times book for a little while. You get this thing trading up at $70 or $80 a couple years out. So there's a lot of opportunity here. But as I said to my neighbor who was interested in buying things that were already up, was that, if it took another leg down, let's say they announced that they're going to cut 100% of the dividend, which in the short term people would view as negative, or dividend funds would have to sell. There would be structural selling. I would be there buying. And the type of person that asks a question along those lines, as long as they are mentally prepared that they're buying at a huge discount to intrinsic value. In a few weeks back, I was on with Liz, and I said, Liz, Liz Clayman of the Clayman Countdown, do you think Wells Fargo is going to do 50% less loans next year than they did last year when it was trading in the 50s and 60s? And she goes, of course not. And she's absolutely right. And that's the way you have to think about these things, is this is a short-term dislocation. There is a movement in the market right now towards growth. Why? Last month, it was values and cyclical because the recovery was coming out of the gate very, very fast. It switched back to tech for the last few weeks because the cases were spiking up, which meant that the recovery would be slower, which meant that rates would stay lower, which meant that overall growth would be slower. And when you have overall growth slower, you have to put all your money into those few growth stocks, i.e. FANG and the like, some of the cloud stocks, etc., because that's the only place you can find growth if the recovery is going to be slow. Like I said in the article this week, if you get a vaccine or a treatment or some breakthrough, and we'll talk about a few that are on the table right now, it changes absolutely overnight, as we saw a taste of today with Wells Fargo up 6% on better than average normal volume. On a Friday in the middle of summer, it had above average normal volume on a 6% spike up. We saw Treasury yields start to go up. We saw also this morning some good news about a treatment, namely Gilead's remdesivir, that showed a 62% efficacy rate, which we'll discuss moving forward. So the second the narrative changes from this renewed fear of slow growth, slow recovery, fallback, reclosing of the economy, which is not going to happen under this administration, then all the money is going to pivot back into value cyclicals on a relative performance basis. That doesn't mean that all the tech stocks crash and no one buys tech stocks. That doesn't mean that. It means relative outperformance. So just like they've been relative underperformers when growth looks slow and rates are low, they will be relative outperformers when the recovery looks fast and rates start to look like they might be able to tick up. When inflation expectations at historic lows look like they can start to tick up. So, Buffett said an important thing in the 2009 interview after they cut the dividend. If you make them sell a lot of common equity, it would kill the common shareholder. That's not even on the table right now. So that's why getting this business at a discount to intrinsic value is so attractive. If there was a risk that they'd have to raise a lot of common equity, that would be worrisome. Buybacks, they've stopped just out of an abundance of caution, even though we haven't hit anything near the severe scenario that they put into the stress test. Dividends, they could cut to zero. I'd buy more because they'll just accrue that shareholder equity inside the company and they can pay it out later, which in effect, like we covered last week, it's like pumping air into a ball. The price would effectively go up because that intrinsic value is being accrued versus distributed. So what will be interesting to see this time is after the bad news is out on the 14th, and maybe people started to front run it today, could be part of it. Obviously, yields started to go up. That's a good thing for net interest margin. But how long does it take to trade back up to book value, which is currently around $40 after all the bad news is out? And that's the case that Susan, the analyst, was making in the Barron's article. Susan Roth-Katsky of Credit Suisse. So that is worth bearing in mind. Okay, moving on. By the way, even if they do cut to that level, the 20 cents, some of them are looking for 26 cents, but at 20 cents, you're still looking at a 3.2% yield at yesterday's prices. That dwarfs the 10-year yield, which was at 65 basis points. So you're looking at 5x yield. It's still very, very attractive, even for those people who need the dividend relative to what they can get elsewhere. And it was trading at a 38% discount. It would have to appreciate from yesterday's prices over 63% just to trade back up to book. Never mind if we get a euphoric run and a treatment or a vaccine or something that changes the narrative from a W back to a V, in which case you could trade at historic extremes, just like you're trading at, 65% a book. You could be trading at 165% or 200% a book on the flip side when you overshoot on the upside as well. So we covered Charlie Scharf. We also covered the concept of why cyclicals and value outperformed about a month ago, and tech and growth outperformed in recent weeks up until today, when the banks just absolutely took off and led the charge today. And the last time that the S&P 500 dividend yield to the 10-year Treasury yield was at this much of an extreme was 2009, coming out of the recession. And what performed like crazy? Banks and cyclicals in the short term. And then as growth slowed, then you got tech, in the mid and later parts of the cycle dominated. But we are at the beginning of a new cycle. That's that. The other thing that we noticed was another chart from Sentiment Trader. You can check them out on Twitter. I think they have a website as well. And they pointed out all the times that insider buying in financials got up to these levels. It preceded multi-month and multi-year rallies in the financial sector. And we're getting up to those levels now where there's a lot of insider buying. Like you saw Charlie Scharf with $5 million of his own money in March after the stock had dropped 45, 47 some odd percent. You can buy. What I love is that we own it below the price that the captain of the ship was buying in meaningful amounts. So that's a big deal. And, Charlie Scharf is so experienced, and he's been around for so long with Jamie Dimon and Sandy Weil. And so he knows the playbook. This is second nature to him, and this is a really, really good captain to be perfectly aligned with at a better deal than he got, which I like. So the other indicator that was posted on Sentiment Trader was this Berkshire Hathaway, which is another financial, to S&P 500 ratio. At all these points when everyone started to say, oh, Warren Buffett's lost his touch, the greatest investor of all time over, 6-7 decades, people say he doesn't know what he's doing anymore because you're at a different point in the cycle from when he makes all his money. But we're moving into the period that he does make all of his money. And we may be even moving into a generational period, which we covered in last week's note, about the value to growth when his teacher, Benjamin Graham, started his hedge fund, and compounded at 20% average for 20 years, was at a period just like this. It's only happened about 4 times in the last 2 centuries where the growth to value ratio had fallen so much, and he started his hedge fund like right at that inflection, and that enabled him to have that outperformance. And then Buffett carried on with the coattails in that trend. And we're kind of at that inflection period now as well. So you can go back and check out last week's article. This is the Berkshire earnings yield discount / premium to the S&P 500 earnings yield. And when it gets down to these ratios, it tends to inflect. We like this because everyone was piling into Berkshire. And then he, made those comments about the airlines, and then a lot of big names got out of Berkshire. And now the sentiment is really, really negative, and that's when it can move with all the other financials. So we like this inflection. We like the story there, buying that at a discount to intrinsic value alongside Warren Buffett. That's always been a good bet. No, not dissimilar to in, the late 2000s and late 90s and early 2000s, when everyone was saying he lost his touch because people were making all their money in Cisco and Amazon. And then all of a sudden value took over, and, he had a monster run in the early 2000s. So this shows another indicator of the post-recession recovery. Cyclical trade you can get a taste for, and commodities tend to outperform. And we're going to talk a little bit about that at the end of this call. These are some charts from Barry Bannister, head of institutional strategy at Stifel. It kind of shows you where we are now in the commodity cycle and how that reverts over time, how it has implications on social populism, and as commodity prices and inflation rise, that tends to reverse itself, etc. So worth looking at those long-term cycles, not necessarily trading on it per se. But the two key risks that we're facing to breaking through this range here to year-to-date highs on the S&P, maybe filling that gap and maybe all-time highs in the next 12 months or sooner. Risk number one are the case spikes, okay? We've seen major spikes in the Sun Belt in the past couple weeks, but at the same time, we're seeing cases in the Northeast plummet. It's more likely that the first wave has migrated than the beginning of a second wave, because if you look at these numbers, they didn't have many cases in March. Now they're all coming at once. So it's probably just a delayed reaction. If you think of the U.S. as Europe, all of the cases didn't start in Germany at the same time that they started in Italy, as the same time they started in UK. They kind of migrated from place to place to place. So these data points, every single one of these Sunbelt states was coming off the boil. I have the updated data in the last 24 hours. It's almost telling the same story with a few exceptions. So I do want to cover the updated data just to give you a look to where we are right now. This is Texas. It spiked back up. July 7th, it was at 10,028 cases. Yesterday, it was 9,782. So hopefully that's coming down now that they have the mask order in. Georgia re-spiked after it fell off. They're now hashing out new policies that they're going to put into place. Hopefully those will start to come down. So that is a negative development in Georgia. California has continued to improve, so that's good. July 6th, they were up to 17,000. Yesterday, they were down to 8,900. That's a big one, and that's a huge part of GDP, so that's very comforting. Florida spiked on July 4th at 11,400. Yesterday, it was 8,900. So moving in the right direction. They have some work to do, but moving in the right direction in Florida. Arizona peaked on July 1st, 4,877. Yesterday was 4,057. So moving in the right direction, some work to do. But if you only listen to the headlines with cases spiking out of control and all that stuff, yeah, work needs to be done, and there's no question it's a risk. But if you look at the places that they had these type of spikes that you're seeing in the Sun Belt, we had those in March, and we peaked in mid-April. So they're about 3 months behind us. It looks like they're coming to the peaks that we had in mid-April. And look what's happened to Connecticut, where I live, completely plummeted. Okay, look what's happened to New Jersey. Huge spikes like they're having with those mini spikes like you're seeing in Florida and Arizona, completely plummeted. New York, huge spikes up till mid-April and then completely plummeted. So hopefully this is the roadmap for these Sunbelt states. The other thing that happened is none of us really took it seriously in the Northeast until people around us started getting sick, and then we all stuck our masks on when we went out to public indoor places. And I think that people are starting to realize that the way to beat the enemy, putting on a mask is not weak. Putting on a mask is strong. If you're a soldier going to battle with any enemy, you have to have a weapon. And right now, the weapon we have is masks. And how is that a weapon? It's not a passive weapon. It's an active weapon because you're starving the virus and not giving it a host. So you're actually starving the enemy to death by wearing a mask in public. And that's a sign of courage and going into battle with and intelligence, going into battle with weaponry versus going into battle to the front lines naked. You wouldn't go without a rifle to the front lines. So why wouldn't you want to starve the beast and crush it and destroy it so we can get millions of people back to work, get things humming, and get back to normal even quicker? So we've done it in the tri-state area. You can do it all over the country. and we'll have more freedom than we've ever had. Because not going to restaurants, not going to ball games, not going to concerts, not going to hockey games, that's lack of freedom in my book. Wearing a mask to get that freedom back, in my book, is a way to get freedom. So it's just a different way to look at it in the short term. And in a few months, hopefully before the end of the year, we'll have a vaccine. Maybe if we get lucky, we'll have a treatment even sooner. And then we can all have mass burning parties, and I'll be the first one there with the, with the lighter fluid. Don't worry about that. Okay, so that was the first risk. So bad news is some of those states are a little iffy, but going in the right direction. Good news is we know the roadmap works. Just like we saw China's recovery, they were a few months before us, and then we started recovering economically. They peaked in February, we peaked in April. Same thing will happen here with the roadmap. The second thing that could throw us off course is if Chairman Powell has done a masterful job of saving the economy from the abyss, along with Secretary Mnuchin, Larry Kudlow, and the administration as a whole. And I'm concerned that he might tap the brakes too soon. In the last 2 weeks, he's reduced. Okay, so this is a nuanced thing, and I'm going to cover this because the balance sheet has come down by about 80 some odd billion in the last 2 weeks now. The data came out today. It's nuanced because Treasury purchases have gone up, which I was concerned about. The data I had on Thursday was as of July 1st. The new data came out today because it was delayed from the holiday. But this type of rhetoric, so the point that I made was, why would you even consider lightening up on purchases, even a hint, with unemployment at 11.1% and limited inflation? And like we saw today in the PPI, so there's no real short-term inflation risk. Intermediate to long-term, we'll know when it comes and we know how to handle it. But the New York Fed head of markets group, Singh, said Fed bond purchases could slow if market conditions improve further. Seen dramatic recovery in market conditions since mid-March. Okay, no kidding. We're not going to keep purchasing assets forever. We know that. But when unemployment is still at 11.1%, albeit moving very quickly, quicker than expected in the right direction, and inflation is, nowhere to be found at the moment, why would you even verbalize anything along those lines? Like, why would you even come out and say that until you were at 7% inflation, unemployment, and 2.5% inflation plus for like 3-4 months in a row? Then you can say, as conditions improve, we're going to stop on buying in your forward guidance to help, contain those trends. We're not there. So right now, the message doesn't need to be slow. Purchases could slow. The message needs to be doubled down until we get unemployment down to 7%, 6%, 5%, which we can do before the end of the year, so long as the right actions are taken in the Sun Belt and maybe we catch a lucky break with some treatments, etc. So I'm going to move over to the new data, which actually Tyler Durden, his pen name over at Zero Hedge, put out. And I like Tyler's stuff because, he posts my articles sometimes, which I appreciate. And he puts out a lot of good data. So he broke down the new information that came out. It's as of Wednesday, but it was published today. And the good news about the decline, so you see they ramped up the Fed balance sheet here, and it's really started to roll over their net assets in the last couple of weeks. You can see it here too, the weekly change. It's really gone negative. But what's it attributable to? And with the new data, he was able to put a nice article together that Treasury security purchases and bonds have actually gone up $18 billion. It's the repo agreements. So you had the repurchase agreements, which was, if you remember, that was the short-term funding was acting funny in the first 3 months of the year. They were doing daily repo operations, overnight operations, and they had to do big, like they were doing like 80 billion a day, like crazy. And then also the central bank liquidity swaps. So in other words, the crisis mode aspect of the balance sheet increase is behind us. So they've actually been able to wind down those programs, which is a sign of underlying health. There's no sense in keeping them going if there's no demand for short-term funding. There's no tightening in short-term funding. So people have thawed out. the fear is out of the system. The pipes are functioning properly. That's the good news. And they're still increasing securities purchases, and he also put some information down about corporate credit facilities. It looks like they did about 10 billion, or they were doing about 7 corporate bond ETFs. Disclosed that as of July 8th, there was 10.4 billion in book value of holdings, an increase of 754 million from the 9.7 billion a week prior, which means the Fed is now buying about 150 million in corporate bonds and or ETFs every single day, a sharp drop from the roughly 300 million a week it was buying just 1 month ago. So the good news is the balance sheet is declining in those areas which were emergency measures which are no longer required in short-term funding markets. The bad news is it's net declining, and it shouldn't be declining until you get unemployment down to mid-single digits, get back to pre-COVID levels if possible, without overwhelming inflation. So use this gap opportunity now that we know the sources of that reduction in balance sheet to ramp up asset purchases in order to get that liquidity into the system. And more importantly, the thing that I pointed out in the article is, there is a narrative in the market, kind of a wealth effect and what it does for sentiment. So the Nasdaq's made new highs. That's a good thing because it kind of takes the double dip narrative off the table. But I think Main Street really needs to see the Dow and the S&P 500 at new highs, because they're all saying, oh, it's going to go back down. You all have your family and friend members like, oh, this is just fake and it's going to recrash. And I think what it would do to consumer confidence and spending and business confidence and hiring to see the S&P either, make year-to-date positive or certainly all-time highs, and similarly with the Dow, and then naturally followed by the Russell 2000. That would be probably later. That takes the double dip narrative off the table, and at that point, if you want to lighten up once and let things consolidate, etc., and unemployment continues to go down, millions get back to work, Chair Powell is well aware of the risks to structural unemployment for the most at-risk groups, because he saw what happened after the 2008-2009, and he brings it up at every press conference that he has. So it's on him, having that knowledge, to keep the pedal to the metal and double down until, and ride the momentum, because it's much harder to regain momentum after you lose it than it is to advance momentum. So he did all the heavy lifting, 80% of the job, establishing momentum in a crisis, and he did a superlative job coupled with Mnuchin, Kudlow, the administration, etc. All the programs worked. But now is not the time to let up in any way, even if the cause of the balance sheet reduction was, funding sources and emergency funding that is no longer needed. Fill that gap with normal asset purchases to take things to the next level, to reinstill confidence, and to let the economy heal on its own now that we have momentum. So those are the two things that are at risk if they tighten too early. And we don't need this type of thing like, when things get great, we'll stop buying bonds. Like, who cares? That's Captain Obvious. We know that. Things aren't anywhere near great yet. They're going in the right direction, faster and better than expected, but you still got millions of people unemployed that need to get back to work. So this type of rhetoric does not help, nor does reducing the size of the balance sheet at this stage. In other words, you've done a miraculous job. Keep it up. Don't let up is kind of the message. And if they follow through on that, they're going to go down in history as saviors of a Great Depression. They kept us out of a Great Depression, put millions of people back to work quickly, and they will make history if they follow through. If they quit before the finish line with 80% of the job done, then that's the worst thing that could ever happen, because we've spent all this money and we've added all this liquidity, and then we'll have to do it again, and future generations will be paying forever. So you have to push while you've got the momentum, and then eventually it'll fly on its own. The other thing that I loved about this week in terms of sentiment, we're moving on to the short term. The bullish sentiment only moved up to 27%, which historically favors being a buyer versus being a seller. It was up from 22, but nowhere near euphoria. We would need to see this up closer to the 40% before we got a little bit, aware and maybe lightening up and that type of thing. So it's nice to see the market moving without sentiment moving. It means there's a wall of worry we can continue to climb. You see here, we're down towards these levels, not towards these levels where you have to start to be cautious. Fear and greed index, again, same thing, right in the middle of the range. It pinned down at 0 in March. It hasn't gotten up to euphoria 80 to 100 this whole entire move, this whole entire consolidation. At 80 to 100, I'd start to say, what could I lighten up? We're not there yet. That's good news. The National Association of Active Investment Managers actually got new data. It's up to 85. But as you see historically here, and I did this 10 years, when you come out of these huge drops like in 2011, and this is similar to 2011 in a number of ways, but once you finally get over that 85 level, it can stay pinned up there for years as the market rallies. Exact same thing after the 2015-2016 crash. After it got up over 85, it stayed pinned there for a while. So we've just had this crash here, and we're just now making it back up to 85. Don't be surprised if this doesn't stay pinned up here with that kind of exposure as people chase back in. Just a note to the people listening to the podcast, if we get cut off in the next few minutes, you can go to hedgefundtips.com and listen to the last few minutes on the website. There'll be a VideoCast. Just fast forward to the end and you won't miss anything. We do have a lot to cover this week because last week's was a little shorter and a few more things to go. Our message for the week on the article was the 3 most important things we're watching in the coming days and weeks to determine if the S&P 500 can push into the green for the year or pull back in the short term. Our number 1 is new cases, which we went through. 2 is the Fed balance sheet. Now we know why it was coming in the last 2 weeks, but we still want to see it going up in the short term until unemployment comes down. And then Q2 earnings season and forward guidance. The good news is expectations are so low. Easy bar to step over. People are less interested in the earnings as they are in the forward guidance. And we'll see if the guidance starts to sync with the economic surprise index with everything coming in better than expected in recent weeks. So in the interim, we'll hold what we have and shave only in the event we do hit levels of euphoria that we've not seen since February. We just went through those levels. And until then, it's only a question of whether it takes weeks or months based on the 3 factors above. And when we'll be able to sing along with AC/DC for the S&P. Yes, I'm back in black. Get the S&P back into the black. Positive year to date. Okay, moving on. The other aspect that I put this chart up regarding the bank's thesis that we've been belaboring in a good way is the last 2 times the yield curve has steepened this quickly, and I've got the 210 yield curve, 210 spread here, was 2009 and 2003. And if you look here, you can see the updated version. I know I've shown this in recent weeks, but basically after you have a crash in the financials, the green line is the XLF, the green line is the XLF, the yield curve steepens. And, everyone's talking about, well, banks can't make any money because rates are so low. That's not the issue is the spread. If the short end is 0 and, 0 to 15 bips, and the Fed is talking about yield curve control, which means they're going to keep the whole short end of the curve down. They're going to move out from the short end, which is at 0 to 25 bips, and take that type of rates to the 3-year and the 5-year, and let the long end do what it's going to do. This spread, it's basically going to be pouring buckets and buckets and buckets of money into owners of banks' laps, i.e. profits, because the cost between their cost of goods sold. What do they sell? They sell money, okay? So they lend money to people who need it. What they pay for it is the short end, and what they lend it at is the long end, and the wider that spread gets, the more money they make. And that's why you see this every time after the crash, the Fed steepens the yield curve so they can start to make money again, because the health of a recovery is totally parallel to the health of banks' recovery, because if banks are healthy, they can lend more, extends credit to Main Street, consumers, small businesses, etc. And that's what makes everything get back to normal. And here we have the exact same thing. You had this crash low. The spread increased up to here, then it pulls back a little bit, just like we're seeing right now. By the way, this is very interesting. 2009, I didn't even look at it this way. You had this bounce off the bottom, then a pullback in the XLF, bounce off the bottom, then a pullback in the XLF. This spread starts to roll over a little bit. This spread starts to roll over a little bit here, and then boom, multi-year rally, same exact story in 2003, same exact story in 2009. I just find the visuals help people see things better. It certainly does for me. Okay, we went through COVID, went through the balance sheet, the repo. Okay, this one, controversial political football. I don't really care about the politics of this. All I care about is the results. CNN put out an article over the weekend that they were surprised by a new study that found the controversial anti-malarial drug hydroxychloroquine helped patients better survive in the hospital. Okay, so this scientist on Twitter pointed out to me, and in a helpful way. So look, I'm not a doctor, I'm a market guy. I think at this stage, I don't care what politics you are, political spectrum. If you're not rooting for a treatment, you've got a problem. So leaving that aside, I think everyone is on the same page. Everyone wants a treatment. Everyone wants to get back to normal. So long as it's safe. Efficacy, we're not going to know. I mean, and we shouldn't even care, because in the sense that we don't have time for double blind, triple blind, all that stuff. All we have to know is, will this stuff hurt someone? If the answer is no, then you can take it. And what this study showed was that the mortality rates declined for those taking hydroxychloroquine. Now, what the scientist pointed out to me was 10% of the people weren't counted, so that could have skewed the results. Okay, I agree, fine. 10% margin of error. Let's say it all went the other way. It still showed some result. The other thing that he pointed out, which was really valuable, was he said that there was a good portion of the people in the study that used that steroid that they used in Europe that worked exceptionally well. And to that I say, great. Okay, so people will take hydroxychloroquine with the steroid to get these type of results. That's a good thing, not a bad thing. So, as someone popular would say that we know. So anyway, this is not the silver bullet, but the most important thing about this study is not whether it works or not, or whether you're Democrat or Republican, or whether you're pro-Trump or anti-Trump. Who cares about any of that? The key is it going to get more people back to work sooner in a safe way? And what we found in this study result is that if you give people this pill after they have a fever versus the previous studies after they have a ventilator, it works a lot better. Okay, so in the previous studies, they were giving it to severely ill patients after they got on a ventilator. And at that point in the cycle, based on what we knew, if you had a ventilator, you had an 80% chance of dying. So you give people a pill as a Hail Mary and they die, and then you say the pill doesn't work. Well, that's not fair. So now, if you give it to them early days, like after they have a fever, it's showing that there might be some edge. Now, let's assume there's no edge. The other thing they found in this study was that there were no cardiac events, or de minimis amount. You can read it here on the website. Here we are. The combination of hydroxychloroquine plus azithromycin was reserved for select patients with severe COVID and with minimal cardiac risk factors. Right savings. Okay, it's important to note that in the right settings, this could potentially be a lifesaver for patients. Dr. Stephen Kalkinis, CEO of Henry Ford Medical Group, said in a conference. I thought the other thing that was interesting was that one of the people who led the study had a conflict of interest with Gilead. Why that's interesting is because these are not the results you would want to see if you worked for Gilead. Meaning, if hydroxychloroquine helps people in early stages, they're not going to need remdesivir in later stages. So that led me to believe that this was an objective study because the parties carrying it out were incentivized not for it not to work effectively. If you wanted to be cynical about it, I would just say they're professionals and they're doing their job. They're giving one group the pill, one group a placebo, and seeing what happens. And I think that's what happened. So I guess the net takeaway is that maybe, it's not a silver bullet. It may or may not work. It has to be in a controlled environment so they can monitor the health stuff with the electrocardiogram, but it may not be as bad as was reported. And if we have these little edges across samples of millions of people getting cases saves thousands of lives. So my message is just be open-minded that in a supervised environment with doctors, with the heart thing, maybe it's not such a horrible thing. And look, read the study and do your own work. That scientist who was anti-hydroxy gave me some bits of information that were helpful, and the study still speaks for itself. Now, President Bolsonaro of Brazil, I think with the advent of CNN publishing the study or reporting on this study, Bolsonaro got COVID on Sunday night, and on Tuesday he tweeted that he felt sick on Sunday, so he immediately started taking hydroxy, azithromycin, and I think probably zinc. I have to confirm that. That was like the original formula from that doctor in New York that had like 800 patients get well. Again, anecdotal, but as long as people are supervised, and I'm sure President Bolsonaro's heart is being monitored by his doctors. But I think that, and he's saying he's feeling really good now after taking it for a week. Look, it's just an anecdote. People have to be supervised and it has to be, but if we have a little edge on millions of people, it's tens of thousands of lives. Be open-minded until we get the vaccine, hopefully 3-4 months from now, and then this is a non-issue and we have our mass burning parties, etc. So it was nice to see that. Eyes on Bolsonaro to see how he does as one more anecdote. He's in the high-risk group, but he took it early on, and that's the key that we want to watch is what happens to people. Imagine if everyone who got a fever had something they could take early on, which which prevented them from getting to the severe cases. I don't know if this is it or not. Hopefully the doctors and scientists will email me or DM me or reach me on the website and give some feedback we can talk about. But all we can do is report on studies and let people make their own decisions. Speaking of which, on Sunday, here's what I do know. I know about a dozen people who took hydroxy in early days and got well, so I'm biased. But those are only anecdotes. I don't know anyone who took it who had a heart problem. I don't know anyone who took it who died. I'm sure you can find just as many of those. But the one that's really, I've been getting nonstop positive feedback about is ivermectin. And, the doctors and scientists, you can come at me on email and educate me. I'm a market guy. I'm not a doctor. All I can do is put out the information. But what caught my attention was last week, the president of Dominican Republic's, two things. If you've been following my podcast, I've been talking about ivermectin for 2 months. Why? Because I'm friends with and know concierge doctors in the tri-state area that, service very high-end clientele, and they all are giving their clientele ivermectin in the first 48 to 72 hours, and they're getting amazing results. Okay, it virtually works on everyone. That the small sample of doctors and their patients have taken it, dozens and dozens and dozens that I personally know of or through, it works. So why the administration is not on top of this yet, I think and hope. Look, they obviously know about it, so maybe they're doing more studies first. Maybe they're making sure we have the supply first. But, something like this, and I don't know if it's Bolsonaro taking the forbidden drug or if it's ivermectin that only the rich people are taking right now. Or, here in Dominican Republic, they did it by necessity because it's a very cheap drug. People were dying left and right, and finally some doctor figured it out because there were studies in Australia. This is not some secret. If you do a little research, people know about this all over the world. But so basically what he said, Dr. Redondo, who runs the biggest, largest private healthcare group in Dominican Republic, treated 1,300, again, most important word, early stage. The minute you get the fever, you got to get the treatment. Early stage COVID treatment patients, and has observed dramatic results. From the 1,300 COVID patients he treated with ivermectin, 99% of them have been cured. The average duration of the full infection went from 21 days to 10 days. The drug starts inhibiting the virus within a couple days in humans. The only side effects have been mild heartburn and diarrhea. Okay, so I can get that just going to Taco Bell. If I get a fever, you can be damn sure I'm on this drug. Okay, anyway, trust me. So, and I'll be back doing my podcast 24 hours later. So there you go. Now, again, I'm not a doctor, so all the doctors and scientists listening, please email me and tell me why this is so bad for people and why we aren't using it. But I'm just looking at results, and there are tons of studies. Here's the next page. You go to trialsitenews.com, type in ivermectin. You can see basically every study going on in the world, and there's a ton of them. Italy. I know that Baghdad, Israel, Delhi, Brazil, Dominican Republic we just covered, and then WHO and Pan American, Singapore, Thailand. There was another country with a B. Anyway, you can check it out yourself. I'm big on this one because this one hits home. I know people using it and getting results. So here are the rest of the studies. If you go to the website on the right side where it says popular posts, it's the second one. It was in the Be in the Know 20 key reads for Sunday. I posted like 4 links to all the studies and all the data so you can read it and draw your own conclusions. And hopefully our medical community will not only be telling us to wear a mask when we go out in public, but we'll be speaking about these things soon and saying whether they're safe to use and how to get them and what's happening to people who use it. So here's more of the studies. And then if you go to clinicaltrials.gov, there's a ton of studies that are recruiting in the United States as well. I think there's one at Johns Hopkins, but you can just see all the studies all over the world and the results and the control and the variable group, etc. So clinicaltrials.gov, type in ivermectin. Next, again, and I'm going through these different treatments and vaccines on the basis of how things can shift overnight. Like you saw this morning, everyone yesterday was doing cartwheels for tech and Amazon and Microsoft and Facebook and all these companies, and then it changed in a day. Whether we get follow through or not, we'll see. But what did it change on? It changed on the remdesivir results improving from what we knew that the treatment is better. And all of a sudden, people said, well, the recovery is going to be quicker. If the recovery is going to be quicker, I got to get into cyclicals. And where did they go first? They went to banks. And all the big banks were up over 5% with Wells Fargo leading the way. So the last shall be first. Okay, so this Maryland man took one of the Pfizer. He's part of a study at the University of Maryland. And he's seeing results, is producing antibiotics. Again, this is just an anecdote, but he thinks he was part of the group that actually got the vaccine, and he feels like it's working. So, stuff is happening is all you need to know. Gilead says the remdesivir coronavirus treatment reduces the risk of death in severely sick patients by 62% compared with standard care alone. That's what led the shift into cyclicals today, and that's what I've been talking about in the last 2 weeks, that this can turn on a dime. Slow growth, double dip, tech stocks will run. Cure or treatment, cyclicals are going to run. And that's the push-pull. The other thing that happened to Gilead today, which, it's great that remdesivir is doing 62% better, but you got to go to a hospital and they have to stick it in you. They're also working on a inhaled version and also a version for less sick patients. That could be a game changer. Because then you can go to a concert wearing a mask, and if you get sick, you just take your inhaler when you get home, and you're off to the races. So these tests are ongoing, and that was really good news this week. Hopefully that will work as well. Another possible catalyst, Mnuchin wants another round of stimulus checks passed this month, and the date that was in this New York Post was by July 20th. The second round of checks would come after most Americans received a $1,200 sum. Those were the checks in the first thing. They're going to make changes this time. Those checks will go to the most people who need it the most, with lower income, with unemployment, and also, they will not give unemployed people more pay than they were getting in their job. So in other words, if a job opens up, they want people to be incented to take it. But if jobs don't open up, they want people to be able to live comfortably until the jobs do open up. So I think it's a good balancing act, because some people were staying home because they were making more money with the emergency relief than they made before in their full-time jobs. So business owners were saying, come back to work. They said, I'll come back when this runs out. I'm making too much money. So you don't want that perverse incentives. But, like I always say, better an imperfect plan done today than a perfect plan tomorrow. What they did in March and April was miraculous. The other thing that set sentiment in a positive direction this week was Buffett finally did a $10 billion deal, including the debt. People were worried that he saw something that no one else saw. And that's why he didn't do any deals in March. These deals take time. He's got to do big chunks. This was $10 billion. This was a nice chunk. And it was for natural gas assets distribution. And also he got 25% of Cove Point, which is one of the few LNG terminals that exports natural gas to other countries around the world. I thought it was very, very interesting. This is kind of like when he bought silver in the 90s at $4 and made a ton of money on that. He's buying these natural gas assets, which is interesting because here's the price of natural gas. It's back down to 1999 and 2002 lows when you got a huge rally in natural gas. And interestingly enough, Top Shelf Barons put out an article yesterday. Natural gas is rebounding. 3 stocks to play the move. And they were playing Marcellus names, Range Resources, which we own, CNX, and Southwestern. And what's interesting, going back to I said, I started buying personally Range. This to me looks and feels like coming out of the 2001, 2002 recession. Oil was in the tank, natural gas stocks were in the tank, banks were in the tank, tech had led the rally, etc. And then you had this monster 5-year run in commodities and cyclicals and in value stocks. And I think we're in the same point. So basically, I started nibbling around $12, got my face ripped off, bought all the way down. My basis is now just over $4, and the stock doubled from that. But it takes time. And, it goes back to Peter Lynch. The key to making money in stocks is not to get scared out of them. And like I said to my neighbor, I'm buying at 25, 26, but if it went to 15, you'd be puking it out and I'd be buying from you. And it's the same thing with stocks. And if you take it actually off the log scale, because it looks like such a big drop, look, here's where it was. It took a while and it took off back up to $90. You knocked out Chesapeake. You've taken a ton of natural gas offline from the Permian with all the rigs that got shut down, the oil rigs that got shut down. They were flaring the gas. So, you've taken a lot of supply out of the market. Demand is increasing globally as we come out of this recovery for natural gas. You've got the terminals in play. So I'm not doing a pound the table, but I'm just saying, if you bought at $11 or $12, you rode it to 18, then it collapsed and you bought all the way down and now you've got a basis at $4 or $5, it's up to 8. These guys are talking about Range Resources being a key play. They've spent the last few years cleaning up their balance sheet. I'm not saying it's going to be perfect. You could have another Chesapeake. But on the flip side, if you get through this type of cycle, you can see situations where $5 and $10 stocks go to 50 and 60 and 70 over a 3 to 5 year period. This is not the type of thing you want to have in a portfolio where you're measured monthly on performance. But on a personal account, these are the type of things you get a basket of 3 or 4 and, when things are this cheap, this is how money's made. Buffett's buying Oxy. Yeah. Did he get his face ripped off in the short term? Yeah. Is he going to make a ton of money on that in the long term? You bet. Same thing with now these natural gas assets. And he's going to be in the market buying more of these. So I thought that was interesting to see those articles come out and for Buffett to be in the space. And he's not always perfect. Sometimes he's early, but he's very wealthy because he buys things that are down and waits for the cycle to turn, which has been the theme of this VideoCast podcast. We're not going to go through a lot of this data. We covered a lot of it other than the rig count came down, and also that wasn't in the article. The continuing claims beat expectations. Again, more economic surprise index. Initial jobless claims beat expectations. And that was that. TSA is now up to 700,000. I think I made a joke 2 months ago that by August when I traveled, maybe it would be at half of last year, which would be about 1.2 or 1.4. We'll see. We've got 4 weeks to go. Next, earnings, consumer discretionary. If you take out booking, the earnings have actually, for 2020 and 2021, have actually come up in the last 60 days. S&P earnings for 2021 have maintained at above $163. If you recall, we hit 3,400 on the S&P from $163 of 2019 earnings. So it's not unrealistic that we could get to that rate, 3,400, in the next 12 months, if not sooner, because we have a lower discount rate now, and potentially this earnings could actually go up if the right things fall into place with things that people aren't counting on: vaccine quicker than expected, treatment quicker than expected, some of these curves come down, stimulus, etc. Here's the other risk. This is the Ask Me Anything. We're wrapping up now. So the Ask Me Anything question came from David G., who also lives in Connecticut, and he asked, what are the implications, if you have a Democratic administration? And I covered a little bit of this in the last 2 weeks. I'm keeping this apolitical. Let's keep it to the numbers. So right now, the odds don't look good for President Trump being reelected. That said, in 2016, after that famous bus talk with Billy Bush 3 weeks before the election, things didn't look good for him at that point either, and he came back. So you never want to count this guy out ever. That's number one. What I'm less concerned about this. We all have our preferences of who we would like to get elected or reelected. That's immaterial. The question is, what does it mean for the stock market, was David's question, and that's the question I'm going to answer. These I'm on electionbettingodds.com. This is the most important website, in my view, to handicap the election, and it'll be more valuable as we get closer. It's less valuable now. Senate control, it's not looking good for the Republicans. This would be the biggest problem. If you have a Democratic president, a Republican Senate, and a Democratic House, no problem. Bullish, generally. If you have a Republican president, a Democratic Senate, Democratic House, Republican Senate, Democratic House, all bullish. As long as you have checks and balances. Where you have a problem is if you had a Republican president, Republican Senate, Republican House, problem. Democratic president, Democratic Senate, Democratic House, problem. Based on these numbers, if the election were tomorrow, based on the numbers, it looks like you could potentially get a Democratic sweep. That would be bearish for the stock market. Here's why. This is not ideology. This is based on the plan that each candidate has laid out. I don't think this plays out for the full, for the full sweep. I think one of these will be a check and balance, whether Trump wins and then, Democrats win the Senate and the House, or Republicans retain the Senate and the Democrats keep the House, or Biden wins and the Republicans keep the Senate and the Democrats keep the House. All that would be fine. What you don't want is a sweep, because if you get a sweep, then you look at something like this. And this was on Market Watch. The author is Rick Bomer, and he lays out, I think, a pretty positive outlook of what would happen if Biden was elected based on Biden's tax policy. Not ideology, his plan. So, Biden would likely increase capital gains tax perhaps as high as 39% for upper income individuals. That could lead to selling before such a law were passed. Due to higher corporate taxes, S&P 500 earnings would take a 7% hit. I think it would be more than that, actually. Due to more regulation, the S&P earnings would take a 2 to 3% hit. Yes, I agree with that. So about a 10% hit to S&P earnings, which means not only do you get a 10% hit to price, but then the multiples are lowered because you have slower growth expectations, which means you put a lower growth on 10% lower earnings. And then potential restrictions on buybacks. Maybe they'd restrict buybacks. Also, less free cash flow due to higher corporate taxes would be negative for the stock market. Wealthy individuals would pay more taxes. They'd have less money to buy stocks. All in, the foregoing calculates to about a 20% hit to the stock market. I think that's reasonable. I think it could be more because it's not just the mathematical. It's the knock-on effect. It's the sentiment effect. It's the crowd effect when people start selling, the sentiment effect. So to answer David G's question, this is what would happen if you got a sweep with no checks and balances. So that either if Biden gets in, the Republicans have to hold the Senate, or you definitely have a scenario potentially as bad as this. If Trump is elected, the Democrats have to hold the House, or one or the other to have checks and balance. If you get a sweep either way, all Republican or all Democrat, that could be bearish. So my sense is you'll get checks and balances. It'll be bullish. Then all we have to focus on is more stimulus, the cases, the treatments, the vaccines, and everything is going to be great. That's my base case. That's my optimistic case. You have positive catalysts that could, you had something last week. Okay. So this is going to sound silly. Kanye West tweets that he's running for president of the United States, references 2020 vision. I'm a huge fan of Kanye West. Okay. I love his music. I don't have Yeezys, but I have something like them. They're called Allbirds, but I got a few pair of those. I like those. But I would buy Yeezys. I'll probably buy some of his stuff at the Gap. Huge fan of Kanye. I don't know, it doesn't matter who I'm going to vote for. But what I'm going to say is that if he does run, he's more likely to take votes from Biden than he is to take votes from Trump, which could help Trump in some of the battle states. Now, what are the odds that this is a legitimate campaign and he's going for it? I don't know. I mean, I think it would be good to hear a third point of view. I think it would be, good to have that dynamism in the dialogue in the country and being more open to more ideas. That's a great thing. Mathematically, it will help Trump. So these numbers that you see today on election betting odds, if Kanye West follows through on what he said he's going to do, these numbers can change overnight because Kanye is going to get a tremendous amount of support. Okay, he's very well liked. He didn't, become close to a billionaire off of Adidas if people didn't like him and respect him and want to, be part of his stuff. And he's got a big following with all the church stuff that he's done. But it's likely, it's hard for any independent to win. So where do the votes get pulled from? Like Ross Perot pulled from Bush. I think Kanye would pull from Biden, and that would help Trump. And these numbers could just turn overnight if that's legitimate. So to answer David's question, these are where the numbers are today. The biggest risk is a sweep on either side. I don't think we're going to get that. We have to be mindful of it. If we did get a sweep with Biden, those are some of the factors that would come into play and what it would mean for equity prices. Has nothing to do with whether it would be positive or negative socially or as a country. That I'll leave to your own ideologies. I'm just telling you what the math would potentially do to the stock market in the short term. And we'll see. These type of events can change overnight. We saw it in 2016. So just keep your eyes on it. That's a great Ask Me Anything question for the week. And with that, thanks for tuning in. This was a long one, but we had a tremendous amount of stuff to cover. I hope you found it helpful. Can't wait to see you next week. Same time, same place. Make it a great one.